Hi everyone, I'm Ahmed Pirzada, and this video is part of the MSc unit on International Finance and Economics at the University of Bristol. So in this video, we are going to have a quick look at some of the very basics of the banking. More precisely, by the end of this video, you should be able to appreciate the role of banking in the allocation of resources. And if the banking system is working fine, then it's going to be an efficient allocation of resources. But if the banking system is not working fine, then it can even worsen the allocation of resources. The other thing I want you to take away by the end of this video is the role of banks in the money creation process. And you should be able to appreciate how changes in the state of the economy affects this process and why it matters for the real economic activity. But before we get on to that, let's have a brief look at what banks are. And the way we are going to do that is have a quick look at their balance sheet. So I'm assuming that all of you, most of you have a background in finance, accounting, and management. So I'm assuming you already know what a balance sheet is. What I want you to take away is that the asset side of the balance sheet of a bank is made up of these or similar components. So a major proportion of their assets is actually the loans they have issued to customers, to other banks, to the financial market, and so on. That's a major part of their asset. They have invested in, let's say, government bonds, corporate bonds, other securities. That's also their asset. Any amount they have kept in the form of cash, and importantly, the reserves, the amount they have kept at the central bank. So we briefly discussed what a reserve account is at the central bank and why it's important, and we'll discuss it later as well. But remember, this is an important part. So they have to keep some assets in their reserve account at the central bank. On the liability side, an important proportion of the liabilities is actually made up of deposits. That's the money you have kept at the bank, and that's the money which obviously they owe to you. If you want to make a payment, withdraw the money, they are liable to do that. Any loans they have taken from the central bank, any loans they have taken from the banking system, or any other finances they have raised from anywhere to finance their activities or to finance the asset side of their balance sheet. So that's what a typical balance sheet looks like of a bank. And obviously, asset minus liabilities is obviously then gives you net worth. Now, this is an actual balance sheet of RBS. And you can see it very much reflects what I've just told you before. An important part of their asset is actually the loans they have issued to customers. So you can see it's close to half of their total assets. Then again, cash and balances at the central bank. Balances at the central bank are essentially the reserve balances. And you can see that's also a significant proportion of their asset. On the liability side, an important part of the liabilities is obviously the deposits which you have got at your banks or anyone has got at the RBS. So that's almost half of their total liabilities. Then the rest is made up of any other finances or any other means they have used to raise finances to finance their activities. You net them out, asset minus liabilities, that actually gives you the equity or the net. So this should give you an overall picture of what a bank actually looks like, what exactly, or what are some of the major things they do. Now, for the rest of this session, what we are going to do is I'm going to construct an artificial, a dummy balance sheet for two banks. I'll call them Bank A and Bank B. And then we are going to play around. We are going to see what happens if, let's say, Bank B has to issue new loans. What happens, let's say, if how is it that Bank A or Bank B can borrow from each other? Why is it important? And also, what is the role banks play in the money creation process? So all of that, we are going to learn that through these balance sheets during the rest of this session. So over here, the liability side are very similar. So both the banks have actually 100 in deposits and they have a net worth of 10. But the asset side is very different. Then another assumption we are going to make is that all the banks have to keep at least 10% of their deposits in the reserve account. I'll assume that there's no cash to make life easier. It doesn't change anything. But I'll assume it's a cashless economy, and then I'll assume that they have to keep 10% of the deposits in their reserve account to meet the liquidity needs of their deposit base or of their customers. Why 10%? It's just an arbitrary number. In the US, for example, the regulator tells the banking system or the banks how much of their deposits do they need to keep in the reserve account. It can be lower or higher than 10%. It can be very, very low. Or in the UK, for example, the regulator does not say any such thing, but the banks decide on their own how much do they want to keep in their reserve account. And they take the clue from their past practices, or they take the clue from what do they expect the future to look like, how much demand there will be for cash and coins and so on. And therefore, they'll make sure that they have enough in the reserve account to meet the liquidity needs. But for our purpose, we'll just assume it has to be 10% so that we don't have to think about this again and again, because that's not the point of this session. Okay, so you can see here that Bank B has just got enough in their reserve account, 10% of their total deposit. The rest they have actually given in loans, and then they have invested some in securities. For Bank A, actually, they have actually kept a lot more in their reserve account than what they need. So they have excess reserves worth 20. They have issued 50 in loans and they have kept 30 in securities. But remember this for later, that Bank B just has enough in reserves to meet the liquidity requirements of their customers, of their deposit base. But Bank A has actually more. They have more than what they need to meet the liquidity needs of their deposit base. Next, now comes the interesting part. And this is about bank money, or Tobin also calls it as fountain pen money. And to understand this, we'll have to ask a question. And the question is, what if Bank B finds another profitable opportunity which they want to finance? Say you apply for a loan and that's worth 200. The bank looks at your application and the bank or the loan officer think that this is a very profitable project and they want to finance it. The question is, what will the transaction look like? And the transaction will look like this. So the moment the loan officer approves the loan and you have signed the document, now this process has actually created a new asset for the bank. In other words, you owe, the moment the loan is approved, you owe the bank an amount of 200. And that is an asset for the bank, for Bank B. So on the asset side of the Bank B has actually increased by 200. You've got this new asset here. But at the same time, after the loan is approved and you check your account balance is also going to go up by the same amount. Because you applied for the loan got approved, the bank has to credit your account by the approved amount. And you see that in your account, the amount has actually increased by 200. And that's it. That's how, that's the process. That's the whole process. Once the loan gets approved, you automatically you see that the new loans are created, and obviously new deposits get created in the process as well. And remember that deposits are an important proportion of your total money supply. So in the process of issuing new loans, the Bank B has actually ended up creating new money. New deposits are part of the money supply, and because new deposits have just got created, so banks, or Bank B in this case, has actually ended up creating new money. And this should be a bit shocking for all of you. It was for me. It should be hard to get your head around this. Why? Because remember, you might have thought that in order to give new loans, banks have to first go and they have to find new depositors, and once they have enough in deposits, only then they can go on to issue new loans. But nothing like that happened here. They didn't go out looking for new deposits. They didn't arrange anything as such. And then the moment they issued the new loan, they ended up creating new deposits. So it's not what you might have previously thought, that deposits come first and then comes loan. Over here, what is happening is somewhat opposite, that the issuance of loan is happening first, and then the deposits are getting created after. And it should be surprising for many of you. Surely it was for me. Obviously, it's not as simple as what I've just said. There are a bit more complications here. We'll come to that later. But for now, just focus on what has just happened. Now, you might think, okay, fine. But what about people taking their cash out and then depositing it at the bank? Surely that increases deposits as well. Yes, it can. Banks can actually attract people to bring their cash to them and deposit it in the banking system. But remember, notes and coins or cash only makes up about 2% or 3% of your money supply in the UK. So there's only so much of an increase in deposits which can come from that. And again, the cash which the people are actually holding, they obviously need it for some purpose. So any currency people have got in their home, they might actually need it, especially because it's only 2% of the total money supply. So they don't want to deposit it in the bank because maybe they need it for buying and selling at the corner shops or wherever. So there's not much there. So deposits can't increase so much because of people coming and depositing their cash in the banking system. What about people moving money from bank A to bank B? Yes, in that case, deposits in bank B are going to go up, but deposits in bank A are going to go down. So there's no effect on total deposits. It's just about deposits going up in one bank, going down in the other, and total deposits are staying the same. So at the end of the day, it really comes to this process which I've explained here. It really comes down to the issuance of new loans, which ends up creating new deposits. That is, when you apply for a housing loan and your application gets approved, new loan gets created, and then the bank or the banker credits your account by the same amount. So new deposits also get created. That's the major way through which money gets created in the modern financial system. Fascinating, right? Okay, and this is what Tobin calls as the fountain pen money. So in a 63 paper, Tobin says this is, or bank money is essentially the money created by the stroke of bank president's pen when he or she approves a loan and credits the borrower's checking account. That's all. The bank money just gets created through or the loan officer signing off the loan application. As simple as that. Now, I've got a link here. So this document, this is a Bank of England document. It sort of gives a good explanation of what I've just said. And this figure is from the same document. And once you read it, you'll be able to get a better idea of what's happening. And you'll see the paper explain how the balance sheet of, let's say, the central bank, the commercial bank, or the consumer changes before and after the loan, or once the loan has been issued. Now, obviously, it's not as simple as that, right? It can't be. It can't be that simple. It can't be just the banker waking up one day and then just signing off the loan application and then new money gets created. Everyone might just become a banker if it's so easy to create new money, right? So surely that's not true. Surely there must be something else. There must be something missing. And yes, there is. There is quite a lot which matters for this money creation process. The first thing is, remember, we said that the bank or bank B or each bank has to have 10% of their deposits in their reserve account, right? So in this case, the total deposits of bank B are 300 and 10% of 300 is actually 30. But bank B only has 10 in reserves. So if they go on to do this, they will not have enough reserves to meet the liquidity requirements of their deposit base or of their customers. And one day, when you go to the bank and say you need to make a payment because you were issued a loan, the bank may not be able to make that payment on your behalf. And if that happens, then there can be a bank run. So the bank B does not want to do that if they don't have enough reserves to meet your liquidity requirements. Okay, so that's an important constraint to keep in mind. But can bank B do something about that? Maybe they can. Maybe they can still issue the new loan and create new deposits, and maybe they can borrow the money from somewhere. So for example, if you recall, Bank A actually has got more than what they need. They've got 20 extra in reserves. So maybe bank B can go to bank A and say, okay, so I want to borrow 20 from you. And bank A actually says, okay, fine. So it might be worthwhile to lend the extra 20 to bank B and earn some interest on it, or a higher interest on it than what they're earning by just keeping it at the central bank. So if it's worthwhile, bank A or bank B can actually borrow the money from bank A and make sure they have enough in their reserves. And then if that happens, then obviously they can go on to issue new loans and create new deposits. And this is what we see happening here. So bank A tells the central bank to basically transfer the money from their reserve account to bank B's reserve account. So bank A's reserve account decreases by 20, bank B's reserve account increases by 20. But at the same time, now bank A has a new asset on their balance sheet, which is the loan they have given to bank B, not the same amount. And bank B also has a new liability on their balance sheet, which is the loan they have taken from bank A. So the question is, as long as there are excess reserves in the banking system somewhere, then bank B can still go on to issue new loans and create new deposits if they can borrow those excess reserves from somewhere else. Now, this also brings across a very important point. And that important point is that the banking system in this way is able to allocate resources in a very efficient manner. So say you needed a loan, you don't have to go and find bank A. You don't have to go and find a bank which has excess reserves or excess liquidity to issue you new loans. That would be very time consuming, right? Imagine I need to take a loan, and then I have to go and search for different banks and find out, okay, who's going to, or who has enough liquidity to issue me new loans. I can simply go to my bank, and then if there is excess liquidity in the system, then the bank will sort it out on its own, or the banking system will sort it out between themselves. And all I need to do is go to my bank and therefore and apply for the loan and wait for it to get approved. Right? I don't have, so if a worthwhile project exists in London and that needs financing, then those people don't have to go up north, or let's say somewhere in the Europe or outside the world, to basically first get resources and then finance the project. All they have to go to is to their local bank, apply for the loan, and then obviously the banking system, if it's efficient, will be able to arrange the resources if they exist somewhere in the system. And that's very, 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 very efficient. Right? You should probably take a minute off and appreciate this, how efficient this is. But at the same time, it can obviously be very inefficient if, let's say, the banking system is not very worthwhile, and most of the banks in London or elsewhere are simply financing speculative projects like housing or stuff like that. And then a lot of the resources which could be used for more productive purposes are just being diverted from everywhere for those inefficient or unproductive activities. Okay, so it does become, it's a very, very efficient system, but then it can really work both ways. It can really improve or increase the productivity of the economy by making it much easier to finance projects which are worthwhile. But if there are inefficiencies or if there are speculative bubbles, then it can really worsen the allocation of resources in the economy and adversely affect the productivity as well. Okay, so that's one. Now another thing, is it all about reserves? That's it? That's the only thing which matters? Not really. Recall the previous video. In the previous video, I showed you a chart where reserves had actually shot up after the financial crisis, both in the US and the UK, EU, and elsewhere. Reserves had shot up after the financial crisis, but at the same time, I showed you a graph for the UK for deposits. The deposits had almost stayed constant. Total deposits had stayed constant in the UK during the financial crisis. So even though the banking system has enough reserves to issue new loans, to create new money, but it's not happening. Why is it not happening? If it's so easy for the bank to just create new money, why is it not happening? Why are we not seeing that in the data for the financial crisis? And the reason for that is because new loans, remember, it's the new loans, the issuance of new loans which creates new deposits and therefore the bank money. But remember, how much of new loans will get created? really depends on both the supply and demand factors which are prevailing in the economy. So consider the demand side of the story. So in the middle of a financial crisis, maybe firms or businesses, they don't want to borrow to finance new projects. Why? Because the future is very bleak. They're not sure if the returns will be worthwhile or if the project will be worthwhile. They're not even sure which sectors are going to survive after the crisis. So they want to wait and see. They don't just want to invest because there's a lot of uncertainty. Likewise for the households. They don't want to buy a house in the middle of a crisis because perhaps they are not sure what will this future housing price or the future housing market will look like. Okay. What else? Another thing which can matter is government policies. Maybe government makes it much more stringent for people or individuals to go and apply for mortgages. Maybe now the government has increased the income to loan ratio, and therefore now not everyone or less people than before can actually go and apply for the mortgage. So the demand for new mortgages go down. Or last is maybe people even worse, rather than borrowing, people just want to pay back the debt which they owe. So for example, maybe they have accumulated a lot of debt over the preceding years, and now in the middle of a crisis, when they have just figured out that they are very much indebted, the only thing they are concerned about is just paying back the debt which they have accumulated. And that in that case, if they are paying back the debt, what actually happens is that the deposits actually end up getting destroyed. Why? So let's say you've got 200 in your account. So you tell the bank, take it away because I owe you 200. So essentially what is going to happen is that those deposits are going to disappear. So money supply or bank money ends up decreasing. So those are the demand side factors which can actually affect, even if there are enough reserves in the system, excess reserves in the system, that new loans will not get issued. Or consider the supply side. Maybe banks are not willing to lend as much because now the projects have become much more riskier. Or maybe now there's a lot of asymmetry. The banks, it's very hard for banks to know who is worthwhile or not. So say many of the new people have come in and they have applied for the loan because that's the first time they actually need it because it's a crisis. And the bank does not have enough information on those people with regards to whether they are hardworking, whether they will put in their best in the project they are asking the money for, and so on. So all of those factors, and then again, government regulation as well. So all of those things can actually also affect whether the bank, even though the bank can do that, whether the bank is willing to issue new loans. Because remember, it does, while issuing new loans, does create new assets. That asset, if the probability of the default is much high, then the value of that asset is not really, it's going to collapse. So yeah, so the bank has to be forward looking in the sense that they want to make sure that the assets they are creating or the loans they are giving are actually worthwhile, right? So all of these demand and supply side factors in the equilibrium, they are going to come together and they are going to determine how much of new loans are going to be issued. And then that is going to determine how much of new money gets created or bank money gets created. Okay. So that's all. So hopefully now you have a good understanding of how the banking system works at the very basic of it. And you'll have a much better understanding of how banks can allocate resources in a much efficient manner, and also the role of banks and the economy as a whole in the money creation process. So see you in the next video. Thank you.